Good afternoon, everyone. Welcome to another one of our Wednesday webinars. My name is stockdarts, and we are going to do the usual. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish that, we'll take a look at the U.S. dollar, see what it's doing, see how it's affecting gold and silver and oil. Gold actually had an interesting move up, which for the moment is a little odd for me, but we'll get into that once we get to that spot. And then we'll move on to the chart requests. We have a few of you in here, a good amount. And if any of you guys have a chart you want to look at, feel free to put it in there. Let me know what you're looking at. Let me know if it's a stock that you already entered and are looking to figure out if you should take profits or maybe stop out if it's going against you. Or maybe it's just a question on a pattern that you've seen on a chart and you're not sure what to see. Anything like that is fine. As long as it spurs good conversation and we can go ahead and diagnose and take a look at it, it would be great. You can find me on Twitter at stockdarts. Sorry, I don't have the picture up with the links, but you guys know my name already. So if you want to follow me on Twitter, you can say at stockdarts Twitter. Same thing on YouTube. Just search for stockdarts and you'll find me. Or you could visit me at patreon.com/stockdarts if you're interested in any of my analysis of other individual stock trades. I could be looking at some trade ideas and stuff like that. Other than that, let's go ahead and get started. And we're going to start as usual with the S&P 500 and the chart SPY. Last week, we noticed that the market was starting to find some resistance at all-time highs and was starting to pull back. And we outlined a very key area as a spot to look at buying the dip and a target for what we could expect from a potential retracement in the market. And that's pretty much exactly where we went, right? We came all the way down to what we considered to be the nice area around 280, where we could confidently say we could probably buy a dip there. There's probably going to be some support. Now, there was temporary support at the 50-period moving average. Matter of fact, we had two very nice candles that made it look like we were just going to fall short of this 280 and find strong support at the 50. But we opened up this week down, right? And so over the weekend, we had some, I guess, news that maybe affected it a little bit. And so we came all the way down to 80. But over the last couple of days, you've seen that the buyers have stepped in and found some support here. Now, there is the chance that we get another fake out, right? And let me see, Wes. You got faked out by the two big wicks. So yeah, this is a situation that could happen again. I think it probably won't, but it could, right? So you got faked out by two big wicks on Thursday, Friday last week and started a few positions. Lucky most of them were half positions. And you, excuse me. And you have room to add, but you're curious on thought process. Okay, so I think you were right in stopping out if you stopped out. And I think this is where it becomes a situation where you have to really respect the discipline of your your trading process and your trading rules, right? And so we'll kind of spend a little bit of time on this before we continue with the S&P 500 and all this other stuff. People often ask me, when should I stop out of my trade, right? That's one of the biggest questions that someone that's learning to trade wants to ask and needs an answer to, right? And the answer is always going to be different, and it's always going to be based off of what your entry criteria was for a trade, right? So in this particular situation, if we're looking at the S&P 500, and we are, let's say right here, right, this is what, Thursday, the 10th of May, which was Friday, right? So if you're looking at something like this, right, your idea for entering long plays is that we found a bottom, right? We've got these two nice hammers. We're going to zoom in. Right, we've got these two long wicks, and so your thought process here is that we have bottomed out and are ready to kind of come back up and challenge highs. So if the next morning we lose those two, well, then your trade idea was wrong, right? Because we didn't bottom out. Now, of course, it ended up being a fake out, at least up to this point, because these last 2 days we've kind of come right back up to whatever your entry probably was, right? But I mean, that's part of trading, right? And what happens in these situations, what the market likes to do is it fakes you out like this, right? And you tell yourself, you kick yourself saying, no, I shouldn't have stopped out. It was just a temporary blip. And yeah, it was a temporary blip, but you don't know that at the time. And so what ends up happening is you kind of beat yourself up for stopping out and being disciplined. And then the next time we get a gap down, you decide, well, I'm not going to do it because it's going to do the same thing to me. And then what happens is they punish you for that side, right? They punish you for breaking your rules, and that's when it really starts to drop. So um, depending on what your position was, then you might have wanted to stop out. Now, you said you added half positions, right? So you were planning on scaling in. And if that's the case, well, then it shouldn't have affected you too badly because you only scaled in half, looking to scale in. And I'm not sure what your points were for the second scale in. Maybe it's what's happening right now. And that's one of the ways that it kind of makes sense to scale in, right? So, and again, this goes into trading process, and this goes into the idea of how you're going to trade. And I don't want to go too far into detail on that because, again, that's something that we could spend hours on, and is really kind of the focus of my mentoring. And if any of you guys want more stuff like this, let me know. I mean, I could do a group workshop if you guys feel like you don't want to do single one-on-one mentoring. But when you are counter trend trading, buying dips, buying retracements, sometimes it makes sense to do half positions and scale in because sometimes you can't time it right. You know, that's one of the advantages of doing a scale in position is that if you are wrong on your timing, if you get shaken out, well, that's why you did a half position because you get that on the second, and that's one of the advantages. Now, of course, there's cons. There's pros and cons to any type of trading style that you use. But in this particular situation, one of the strengths of scaling in is that if something happens like this, you still have time to go ahead and add because you didn't add the whole position because you understand that your entry may not be perfect and that there's always a chance that you need a better spot to go ahead and enter a second. And that's what we discussed with Denise, and that's one of the things she was mentioning about Amgen and Triple M a couple weeks back, and wishes she was more patient. Sometimes you need more than one entry to get into a name, particularly when you're looking at buying pullbacks. So that's another thing to keep in mind. But yeah, Wes, that's my thought process on when to stop out and when not to stop out. A lot depends on what your trading style is and how you are entering or navigating that particular type of trade. In this particular situation, if I was just buying off of Friday's strength as a swing trade without scaling in, I would have stopped out, and I would have been probably mad that I got shaken out. But that's you got to roll with the punches, right? And that's more often than not, you'll save money with those stop outs than you would have not. Now, there's a whole other thing you could do about what happens on a gap down. How do you stop out of that? Do you just immediately cut it, or do you wait for a bounce? And it's different for each trader and each trader's experience levels. But again, that's something that is really more the domain of a mentoring session than our Wednesday webinars where we're just kind of covering the markets and the technicals. But yeah, the short answer is it depends on what your entry was and whether or your trigger. And if it's invalidated, then you should close it out. And if it's not, if you're scaling in, then you just look for your next scale in position, which is, I would imagine, what you probably had to do. And now you're kind of struggling unless it was some tech names, which again are showing strength, which we'll get into a second. So hope that answers that and gives you guys some insight into how you're supposed to behave in these sort of scenarios. And that's what makes it tricky sometimes, right? And this is all kind of a byproduct of what happens when you have these sort of stretched out scenarios where the market goes a decent amount of time without any real selling pressure, right? You start to squeeze upwards, and you end up getting a lot of selling pressure being built up as more and more buyers sort of chase the longs. And eventually, once you finally have that sort of the dam kind of open, you have this release, and there's a lot of buyers that are waiting to step in. They were being patient, but there's still so much selling pressure that built up that a lot of times you get back and forth as the buyers jump in, maybe a little prematurely, and then the sellers kind of step right back in and push it even further down. And we might be at that same spot again today. Now, again, I think we're at a much more critical support level. I think there's a lot more buyers waiting to step in at these levels than there were maybe at 285. So I suspect that this will hold. But there's a chance that we need to rehash this and test this a couple more times rather than just go straight up. However, I think that the way we're setting up, I think we are going to bounce a little bit higher than this. But there is a possibility that we stall out. So let's go ahead and take a look at those possibilities and different scenarios that could play out. Now, with the S&P 500, as I mentioned, 280 is a key support area. And you can see with yesterday and today's candles, we've had very nice movement, but we're still kind of below the two closing prices from Thursday and Friday last week. We're still below the 50-period moving average. So there is the possibility that this is really just a bear flag, right? And that this is just the first move down, and we're getting the sort of the reaction to that move, and then there's a possibility that we try to push below these levels. I suspect that because this is such an important area, I suspect that we do try to bounce higher. But at the moment, we have to respect the possibility that there is the chance that this is a bear flag and not just a V bounce. Now, that being said, another way of interpreting this, and if you're looking to be aggressive about buying, is take a look at our move right now, right? So if you go ahead and take a look at where we closed last week, right, you can almost see there's a divider, right, between the two closing prices from Thursday and Friday and the highs that we've seen the last couple of days. So if you're looking to buy a bounce here, if you think that we have a good chance of making it back to highs, then what you're waiting for on the S&P 500 is a move past 285. You want to get back above the 50-period moving average. You want to get back within the meat of the candles from Thursday and Friday. And if that's the case, then it shows that we found enough buyers to sort of leave 280 behind and kind of come up and retest. Now, I think it's still up for debate how far we bounce off of this. And I suspect that there's a pretty good chance that if we do start to bounce, we will end up falling short of our previous all-time highs. And for anyone that's really nervous about where we are in the market, that might be a good spot for you to start to take some profits and to start sort of maybe lower your exposure to the market as we sort of navigate this area. Now, I think we're still in a pretty bullish environment, but as I've said before, I feel like price action has been slowing down as we've approached all-time highs. I don't think, going back to the weekly chart and something we discussed last week and the week before, I didn't think that we were going to just go right through this, blow through this entire range that we spent the last year and a half in, and continue chugging on to new highs without testing this area further. And I think at this point, it really comes down to how we go ahead and set up now that we've sort of pulled back off of those all-time highs. Are we going to just spend some time in this area and then make another attempt at pushing past them? Or do we need to retrace even further and spend the next 4, 5, 6 months trading in this range and maybe work on what happens towards the end of the year as to whether then we're ready to move past it? And I think it's way too early to tell. But I think that we've gotten decisive proof that we're not ready to push through these all-time highs yet. And I think now comes the next step, which is trying to figure out, are we going to stay in the upper edges of this range and try again? Or are we going to just sort of continue to just broadly try to chop around as we head into the summer and into sort of the lower volume trading months? The first step, of course, is how do we find support here? And as I said, I think there are two scenarios. One is we have sort of a bear flag, in which case maybe we have to come down and test the 200-period moving average. If we break this trend line to the upside, if we break that 285 that I just pointed out, then I think there's a decent chance we make our way back up to the 20-period moving average and probably about 291 to 292. And at that point, I suspect that we will find more selling pressure, but there is the chance that we continue pushing upwards. So a lot of it's going to depend on how you trail your stops and how you go ahead and trade momentum as it moves back to the upside. I think watching how we bounce there, we'll get a better idea of what we can expect as we head into summer. But for the most part, I think, again, we're at a spot right now where we want to be trading a little bit more cautiously. We want to be looking for areas of strength, and we want to be avoiding areas of weakness. And as we get into the NASDAQ, you'll see that's still the area of strength. I think the small caps, which I was hoping would play some catch-up, are not really doing that. So I think at this point we need to maybe back off of that idea and just sort of focus on tech names for now and sort of really dig in to see where some of the strength is in the market. Now, there is, of course, one other scenario, which is, I think, the least likely, and that is that when we resolve this bear flag, we head sharply lower. I don't think that's really the case, and I don't think that's what's going to happen. But if it does happen, I think, again, we make a pit stop at the 200, and then we'd probably head down quite a bit lower into the lower 270s to 260 area. But I think that we're going to try to push past or try to push higher before we, if or when we do try to end up going more. So what I mean by that is, if we're going to head lower, I suspect that we still have at least one more bounce higher before we try to really head lower. And again, I don't know that we're going to head lower, just thinking that even if we did, I think we still have one more push ahead of us before that would happen. Again, the more likely scenario is we try to push higher, fail, come down, and then maybe test this area again and really sort of make sure that we've spent enough time building up enough new buyers that basically agree that this is a good level. This 280, which again, as you can see, was a major area of contention last year. This 280 all the way down to 263 or so. That was where we really started to try to hold up before we had the real big breakdown at the end of the year. And I suspect that that's still going to be an area that's going to be important as we head into the summer. But for now, we're testing the upper edges of it, and we'll see whether that holds or not. My thinking, again, is that we probably bounce a little bit higher. I'm not sure how much higher we go from here. I don't think that we make new highs. So the question is, once we bounce, how do we react to these levels of supply that are waiting for us? And how do we handle that? And do we continue chugging upwards and try to build up steam to break out? Or do we sort of lose our momentum quickly and head right back down? And I think then that'll give us a better idea of how to go ahead and proceed. But for now, I'm looking at buying the dip. I'm looking at names that are setting up bounces. That's what I put on my Patreon page. And that's what I'm still looking at, and that's what I'm playing, is names that are doing something similar, which is pulling off of highs and finding some support at key areas that should be acting as support. And so charts that are mimicking what we're seeing on the S&P 500, and more importantly, the NASDAQ, are what I'm looking at doing right now. And I'm looking at buying the dip, and I'm looking for a bounce, but I'm not looking for a move through new highs. I'm just looking for a bounce play. Now, we look at NASDAQ, the Qs, and you can see a little bit stronger, right? The idea of a bear flag in this case is probably not going to really be warranted, because it'd be kind of a weird bear flag, right? You'd have to really try to connect the dots in a strange way. Now, it is possible, right? It could be that we're having something like this in a broadening wedge, but more likely than not, if you were just trading the NASDAQ, I would say that this is a good reversal pattern, and has shown good support, right? Got a bullish engulfing candle off of yesterday's candle, move right back to the 50. Now, again, just like the S&P 500, we haven't really broken past the closing prices of Thursday and Friday from last week, right? So despite the fact that this candle is much stronger today, we're quite a bit lower from where we were Thursday and Friday. So we haven't had a full-on reversal. And if we draw that trend line that I drew on the S&P 500, I know it's very steep, but we haven't really broken through that either. So I think at this point, even though I think this is a good reversal candle pattern, technically speaking, from our trend lines have not indicated that we've broken this downtrend yet, right? So if you're more cautious, then you still want to wait for a little bit of a better scenario here before you want to go ahead and enter. Again, I think that there are certain names that are maybe moving ahead of the markets and are already giving good bounce scenarios. But if you're looking at trading the NASDAQ or the Qs, or you're looking for names that are behaving the same, then you want to see them break these descending trend lines, and you want to see more conclusive evidence, particularly when it comes to our closing prices on Thursday or Friday, before you go ahead and enter to the long side. Because it could be that we break through here, and then once we get to the area where we found all the supply on Thursday and Friday, we roll right back over, and then we do have that bear flag scenario. So I think at the moment, probably still in a situation where we want to, where we're waiting for the entry to really trigger as far as the NASDAQ is concerned. I think that we would want to see price action decisively above this descending trend line and probably above that area, this 183 or so. Now, again, that's the problem with that, again, is that the risk reward is not that great once you get to that spot, right? Because now you have a stop way down here, 178, and you have a target, if you're really optimistic, 191, but more likely than not, a little bit below that, around 189, and possibly even just 187, which is the 20 period. So another thing to keep in mind is your risk reward on any particular plays that you're interested in taking at the moment, because if you have a strong bounce, but it hasn't cleared what you consider to be your entry point, then that puts you in a tough spot, because you don't really have a good stopping out point. And once you do have that trigger, so for instance, in this case, it'd be maybe 184. Well, theoretically, your real stop out point is 6 points away, and your target is 6 points away as well, from 184 to 190. 1-to-1, not really the greatest. You trade in the middle of a range, so I think we need to see a different sort of pattern on some of these tech names. And again, not all tech names are the same, right? So if you go ahead and take a look at Amazon, for instance, and you watch what it's doing, this could have already been an entry point, because you're not looking for a move to Friday's hammer close. If we look at Apple, right, again, the same thing, that we're so far below those Friday ranges that there's a room for it to play. I don't think this is an entry yet on Apple. Let's see Google, which is the one that's done the best so far. Again, not really at an entry point. But you'll notice the names are they're all behaving a little bit differently, and they all have their different patterns. So what you want to do is you want to find something that maybe is giving you an entry, and then from that respect, you can go ahead and try to play it rather than just saying, well, the cues are signaling along, so I want to go long, or the cues are not signaling along, so I don't, So for instance, for the cues, if they're not signaling along right now, that doesn't mean you can't find the name that is signaling along. You just have to find one that's maybe ahead of the curve and is sort of leading the way higher rather than following this. Now, as far as the levels that we're looking at and what we can expect, I mean, we've kind of covered them, but our key support area is 178. We don't want to lose that. If we lose that, then I think we're heading down to the 200-period moving average and probably a little bit below that to about 171. Which again is a major area of support. But at that point, we'd kind of be in the same situation that we were towards the the end of last summer, where we're starting to slice through a lot of critical levels. And we don't want to see that. We want to see consolidation at these ranges. Even if we do lose this, we don't want to lose it immediately. We want to be able to see some price action. We want to see buyers step in and push it higher, and then that way we can maybe react to it and play more of our range bound buy the dip strategies or sell highs rather than just having to wait while the market slices through a bunch of support levels. Now above us, we have some interesting areas of resistance now. One which we're at is basically this 183, which is the 50-period moving average. It was our previous high for March, and it's just below the closing prices of Thursday and Friday. If we could push past that, then I think we make our way right back to 187. But again, I don't think that we're ready to push much past that and into all-time highs. I think, again, at the moment, my suspicion is that if we do get a bounce, it will lead to a lower high. But it may or may not happen. But that would be where I'd be looking at taking profits. And if it comes all the way back to all-time highs, then I'm okay with that. Or maybe I just trail a small portion of the trade, looking for it to continue. And I think that's another piece of advice I can give is, at the moment, I'm going to be pretty quick about my profit taking. And if you want to look for higher, then maybe just trail a portion of it. Don't hold your whole trade looking for new highs. Now, we move on to the Dow Jones. You'll see, again, weakness compared to what we're seeing on the S&P 500 and the NASDAQ. We still had a nice bounce today. Still a nice bullish engulfing candle. Very similar in that we have not been able to break our closing prices from Thursday and Friday. Same thing. You want to draw a descending trend line. We haven't broken that either. So at the moment, we're still kind of in no man's land where we could either be forming a bear flag or we could be setting up a bounce and be able to break through it. Now you'll notice we're nowhere near the 50-period moving average, obviously nowhere near the 20, and nowhere near our highs. And we've already tested the 200-period moving average. So relatively speaking, a lot weaker on the Dow Jones versus what we're seeing on some of the other indices. Some of the S&P 500 and the NASDAQ are trading right around these bounce points from last year. Now the Dow Jones, because it was so strong last year, is below that. And we're actually all the way down here at our breakout point, which we're nowhere near on the S&P 500 and the NASDAQ. So relatively speaking, definitely weaker. I don't think there's much to take out of that. I think it's just a matter of money rotating to different areas and away from the Dow Jones. If we start to see a lot of strength in the Dow Jones, that might actually mean that we're going to see more weakness in the market. So at the moment, we just want to see the Dow Jones do its thing and follow the other two. And if it lags behind, it's no big deal. But if it starts to pick up a lot of steam, and, well, more likely than not, if we start to see strength, it wouldn't be because it picks up steam. It'd be because it holds up better than the other two. And if that's the case, then we'd really have to sort of readjust and see whether we are headed much lower. And because money's going to flow towards the safer names and the less volatile names. But again, that's not where we are right now. Right now where we are is just trying to figure out whether we have a good buy the dip opportunity here. And if that's the case, where it could lead to, right? So on the Dow Jones, the key support area we already hit. We don't want to lose that. If we lose that again, that's not a good sign. But it's about 252 to 253. If we do get a bounce here, we need to get past 257. And then we're immediately going to hit a lot of resistance here around 261, 260 to 261, which is our previous area of resistance. It's also the 50-period and the 20-period. So there's going to be a lot of potential selling pressure up at that spot. And again, very short of recent highs and all-time highs. And I suspect that we will not be able to push past them on this next bounce. And if that's the case again, we should be looking at our range-based trades, our covered calls, or possibly even looking at shorts, and not necessarily looking for a market top, but looking for range-bound action where you want to be more proactive about taking profits and quick to re-enter either drops or even position yourself short on tops, right? So it's a spot where we want to be playing based off of channels, based off of previous resistance levels, rather than looking to play momentum and trying to find and trail our stops higher. It just seems like that's the type of environment that we're in right now. And again, for those of you that maybe, I think most of you guys are regulars, but for anyone that's new or maybe anyone that doesn't remember this, a lot of the focus on these Wednesday webinars is the markets. It's not necessarily to trade the markets, it's to try to figure out what kind of environment we're in and what kind of trades are making sense at the time, right? And so, as I mentioned a few weeks ago, I think that we're now pretty decidedly in a broad range again, and I think we've been in a broad range for a few years now. And I think that's been kind of my major thesis for quite a while. And it was looking like we were ready to break out, and it seemed like the market was daring traders to go long and to chase action higher, right? So if we go back to the S&P 500, the market was basically sort of daring traders to play the breakout and trade long, right? And at that point, if you guys remember, I was warning you guys that while we're in a bullish market, the risk reward just wasn't there, and we were in a situation where we were at a major level of resistance on our big broad trading range from the last few years, right? And that ended up playing out. And I think, if anything, just giving us a good tell that we are still in a broad range trade environment, which means we should still be playing range-based trades in the short to intermediate term. Now, in the short term, we did have a very strong rally, and that's kind of been one of the characteristics of this trading range, is that we've had very strong moves in both directions. So we've had strong trends within a long-term sort of trendless environment, right? We had a strong trend to the downside, strong trend to the upside, strong trend to the downside, strong trend to the upside. And I guess if this scenario plays out again, there's a chance that we have a strong trend to the downside again. I don't think that we are at a spot where we need to worry about that yet, but that's something we may need to worry about in the next month or so. And a lot's going to depend on how we go ahead and play out off of this reaction to these highs. And that's why I'm saying if we do get a nice bounce and you're a little bit worried, that might be a spot where you try to rein in a little bit of risk. I'm not saying to close out all your trades, but it might be where you want to go ahead and be a little bit more cautious just based off of the way the last year has been playing out. Now, again, I still think we're bullish, and I'm still focused on the long side, not the short side. And I'll warn you if I feel like that's totally shifted. I think at this point, we're at a spot where I'm warning you that there's a chance it happens, but I don't think it's going to happen. But if next week things look different, then I'll give you a different, more substantial warning. I think right now we're still looking at playing the longs. I think we're still playing range-based trades, and I think that we're still probably going to spend a while, maybe at least another couple weeks in this area between 280 and 290 on the S&P 500, and on the Dow Jones, it would be somewhere in this area between 250 and maybe 260 to 265. And then we'll see what happens as we sort of try to rehash this and try to kind of break through. So that's the key levels on the Dow Jones, is basically 262 and 252. So a nice 10-point range that we could kind of go back and forth and just sort of really figure out how many buyers and sellers are here, and who's, do we have more buyers or do we have more sellers in the room at the moment? Now, the last index we have, and by far the weakest, of course, is IWM. And I think IWM is the one that's printing the clearest possible bear flag as well, right? You take a look at what we have, and that's kind of a pretty easy to see bear flag, right? And a pretty easy to see bearish continuation pattern. Now, it hasn't played out yet, but you have these two big hammers on Thursday and Friday, and then you have these three candles today. And one thing that you guys, if you're ever unsure of price action, you're trying to figure out what's happening here, it's important to realize how you close days, right? So on Thursday and Friday, we close strong. You can see the wicks. And the last 3 days, we've been closing a little bit weaker. You can see the wicks, right? We're losing pressure at the end of the day. So at the moment, the sellers are still in control in IWM. And if you want to see a change in that, then you have to see the wicks on the bottom, and you have to see the price action kind of move its way upwards, right? I think at the moment, it's pretty clear that we're struggling to break past this 153. I think if we do, then we need to kind of come back up, but then look at all the resistance, right? We've got the 200 period, the 50 period, the 20 period. You've got all this broad like area of price action, right around 155. There's a lot of work left for IWM, and it's a shame because it looked like there was a good chance, right? If we just zoom back to this, it looked like there was a good chance that we were going to get some really good movement out of some small caps, and that ended up not being the case at all. And instead, we ended up getting a pretty weak move. And by the way, Wes, very similar situation that you were in was the situation that I found myself in, where this was looking like a really good spot to go ahead and go long a lot of small caps, and it eventually was invalidated, and that's where I abandoned that idea, that trade. Once it's back below that, I think it's proven that your idea is wrong, so you just get out, right? And look what ends up happening in this case. It actually saved plenty of money by not. And again, I wasn't trading IWM, but names that were trading like this, and it saves you a lot of trouble waiting to see if you were right and if you're going to come back and if this is just a fake out or a shakeout, right? So in this particular case, this is more like what's supposed to happen when you stop out. Is it saves you from a move all the way back down to the previous lows, rather than where you wanted it to go, right? There was always a chance it kind of came back, but if it did, then you just re-enter. But this is one of those scenarios like you were mentioning. How do you handle this? Well, once my thesis is invalidated, there's no point of being in it, right? And so at that point, you just stop out and you just let it go. Now, as you can see, the small caps are nowhere near all-time highs. So all-time highs are actually even above this 173, and nowhere near even our recent highs. So this, again, is still the weakest area. I think at this point we have to go back to probably not trading too many small caps to the long side. And more likely than not, when it bounces, or if it bounces, this might be a spot where if you feel like the market is shifting in character, and you want to short, then maybe you want to short IWM and you want to short small caps as they head up into this big mass of resistance. Now, again, I think that's still a little bit bold compared to when you consider what we've done this year, but I wouldn't consider it crazy. And there is a chance that if you do want to start shorting the market, then I think this is going to be the spot where you want to look at it. All right, so we kind of flew by, well, not flew by, but we spent a decent amount of time on the markets, but I think quicker than normal. Overall, I think that we are definitely in a transition phase where we are no longer in that strong rally that we've been in all year. I think we found some resistance, and we are now transitioning back into neutral. I don't think, again, more often than not, the market doesn't do what it did this at the beginning of the year, where you go from straight down to straight up. Usually, you go from one strong direction to neutral and then to the other, right? So you have like a downshift to neutral, and then you start to shift upwards, right? And we've been basically going straight up, and I think we shifted to neutral, as you can see pretty clearly in IWM. It's been neutral for 3 or 4 months now. And the other markets, when you look at the NASDAQ and the S&P 500, we're now switching to neutral there. And we may need a little bit of time sort of rehashing that before we decide whether we're going to switch to bearish or whether we're going to continue sort of pushing forward and switch back to bullish. So for now, still be cautious. I'm looking at buy the dips for this week, and I'm looking at them in very specific scenarios that outline or play similar to what I just mentioned, where we're looking for a close above some of the previous levels, like Thursday and Friday's close, and breaking some of these descending trend lines that are developing, that have developed over the last maybe 2 weeks or 3 weeks. All right, let's take a look at the U.S. dollar. We're going to look at oil, gold, and silver, and then we'll move on to the chart requests. So far, we just have Denise with a couple, and if anyone else has any, I'd love to see what you guys are looking at. Oh, Sam, good to see you in here. So Sam's hopefully still trading Forex and still trading some currencies. Sam, we've had some nice trades on the euro recently. Hopefully you were involved. I don't think I've seen you in these Wednesday webinars for the last couple of, actually maybe the last month or so. But we've had some nice trades on the euro, and hopefully you have been still trading and have caught some of those. Now, if we look at the UUP index, Yeah, Sam, good to see you too. Interestingly enough, we actually had a breakout. Now, the US dollar actually was weak over the last 3 days, right? So if you look at Thursday and Friday and then how we started this week, we've had sort of a shift in character. We've had a move back up. Um, and surprisingly, gold has been strong despite the fact that the US dollar, well, the US dollar is strong today, but it was actually weak the last couple of days, which I think led to that gold strength. But the key here is, as always, the euro. And the euro again had another failure at this descending trend line, right? And it's in the process right now. Now, it's a little bit of a tricky spot right now because it's still above this area of potential support. And we're getting to a spot here where it could be trying to reverse. But it's had some very nice shorts off of every time it hits this descending trend line. And I think at this point, it's starting to flip. It's starting to look like it wants to go bullish, but it is still losing momentum. So this is not as clean as the last 2 or 3 scenarios. And I think, again, if we're worried about the US dollar, we want to see whether the US dollar is going to be strong or not. This is what we want to watch. We want to see what happens to the euro as it sort of hits this apex between these two conflicting trends. Or sentiments. And once we figure that out, we'll get the next move on it. If you're very aggressive, you could probably start shorting now, but I personally think this is a spot where it gets a little bit tricky and a little bit harder to go ahead and analyze. And I think one of the reasons that I think there's a chance we do break out is gold, which I'll point out shortly. But we've had very strong moves down on the euro. And again, if we look at the weekly chart, the euro's still in a good, it's still basically, we lost a key level, right? So this is still a bearish overall play. And I think even if we get a move back up to this 113 to 114 area, that's still a potential resistance level to look at a possible short as it starts to swing to range bound. So this goes back to what we were just discussing in the markets, where you a lot of times you graduate from bearish to neutral and then bullish, or vice versa, right? And in this particular case, we've had a pretty nice bearish move, and it might be time for it to graduate to neutral. But there's still the possibility, if it loses 112, 111, 880 or so, there is a chance that it starts to head back lower, make even newer lows. So we're not really out of the woods yet. I think that there's a key level of support down here around 110, so there's still some decent amount of movement. Glad to see, Sam, that that it turned out great for you. That you've been able to go ahead and take advantage of this. For those of you that maybe aren't aware, Sam is someone that's done a lot of mentoring with me, and we made a lot of strides with him over the last couple of years, and I think he's definitely improved a lot as a trader. And one of the things he found is that for him in particular, Forex was a much better instrument than trading the stock market, based a lot, mostly due to his schedule more than anything else. And so we'll see. Now, you've also traded IWM put spreads and gold silver call spreads, and so those have been working well for you too. So, all right, so you've had your finger on the pulse of the market right now, at least as far as these are concerned. So good to see that. Now, we go back here to the euro and the shorter term chart. I think, again, we're at a spot here where it's a little bit more, I think it's a little trickier to go ahead and play it, but technically it did have a short signal today. But again, I think because of this possible resistance of 111, I'd wait a little bit longer to get a full confirmation on that play. Now, if we look at the US dollar versus the Canadian, you can see it's sort of range bound, right? And we're starting to see a little bit of trouble here in breaking past this 134 to 135 level. And it's still holding up pretty strongly around 134, but it hasn't responded like the euro weakness. The euro chart was inverse, right? So down was good for the US dollar. This is based off US dollar, so up is good. And you can see that despite the fact that we are seeing some upwards movement, it's not really being reflected on the US Canadian, and it's also not being reflected on the US yen, right? So the yen actually has gained a lot of strength for the US dollar, although we've reached a spot here where it looks like it needs a reactionary bounce back to the upside. And I think overall, if we look at the three, we realize that we're at a spot right now where the US dollar is kind of unsure of what it wants to do next. We have a chart that has been bearish, but looks like it's ready to sort of flip a little bit. And we have a chart that has been bullish the US dollar, which is now starting to maybe potentially flip a little bit. And then we've got the one other chart that's kind of neutral, right? So we've got a mixed signal here, a mixed bag. And until we see a little bit of change, maybe we want to wait to get a clear signal. I think still I'm looking at the US Canadian long, not short. If it's a short, it's going to be a tricky trade. So I'm still waiting for a breakout of 135. If it doesn't happen, it's no big deal. Uh, and I think if you wanted to play the U.S. dollar to the long side, you probably want to look at the yen right now and see how it reacts to this trend line here. We've got a nice key level right here. So if you wanted to play it to the long side, that's what you want to see a break past. And if not, if it rolls over there, then you have a continued short all the way down to 108 or so, right? So that's what I'd be looking at right now. And again, I think I'm waiting on the euro a little bit. We've gotten 3 or 4 really good trades out of the euro short right now. And I think at the moment I just want to wait and double check. And if it breaks down below 111, then I think we've got another possible short entry. All right, now, interestingly enough, gold had a big breakout. This is actually a really nice breakout, right? Which is weird because it hasn't been reflected at all in silver. And in all honesty, I don't think it's been reflected at all in the U.S. dollar, right? The U.S. dollar is still, if we just look at the last month, that's still a bullish move. However, we can get rid of that trend line. That's not important anymore. But this is a nice little kind of consolidation range, and we gapped up above it today. But even the last couple of days, we broke past it. And that's not mirrored at all in what we're seeing in GLD. So not really sure where this is coming from. Not sure why it's not affecting silver and why it's only affecting gold. But nice move. And again, looks like it wants to try to explore even a little bit higher when we look at this 3-candle pattern and you look at the wicks. Another thing that's interesting is it hasn't really been reflected in the gold miners. Now they're doing a little bit better. That's actually kind of a tough trend line to draw, but I guess you could say that. And it looks like it wants to try to break past that. So this is a possible reversal pattern on gold miners, but they haven't really followed through yet. Now, the one gold miner that has is Ray's chart, KL, right? And that has done pretty well and has actually pushed past it. And I'm not sure, Ray, if you ended up buying it. I know last time we discussed it, you were looking at 32.80. I don't know. I don't think personally that it actually gave a good entry signal. So I put this on my watch list and I was watching it, but the candle pattern that played out was very hard to trade. And that's going to be the case often with gold and silver because they gap up a lot and kind of gap through a lot of levels. So this actually has done a pretty good job, and it's been a pretty bullish chart. But it would have been very difficult, in my opinion, to buy this, and I didn't. And it's doing pretty good. But a lot of other gold miners that I follow have not actually sort of responded to this move yet that we're seeing on GLD. So kind of unsure where to go with that. But this could be an area that we could look at in the next couple of weeks and see if they pick up some steam. Again, silver, for whatever reason, nowhere near what gold is doing. Now, you might be thinking, well, if silver's lagging, maybe I want to go ahead and play this as it plays catch-up, but I'd say stay away from it. It's been relatively weak for a while, and if you want to play precious metal, you're probably better off playing a gold name than a silver name and just sort of let silver continue to lag behind and do its thing of being bad. Now, the last commodity we want to look at is oil, and oil is actually struggling a bit more than I expected as it comes up to this ascending trend line and this sort of bullish sentiment that it's had throughout 2019. Now, it's starting to shift a little bit, right, where we have, and again, I like to point this out, the wicks, right? We've got all these wicks on the lower side, and then all of a sudden we've got wicks starting to show up on the upper side. So the bears are starting to kind of gain a bigger foothold on this over the last couple of days. And we also have, the one thing we have that's maybe a little bit positive is that it did sort of finally break past this descending trend that it developed in the short term. I think it's in no man's land right now, sort of like the euro, the US dollar, where it's kind of in between two trends. And it's difficult to see what it wants to do right now. There's a chance that it just continues to ride the top of this trend line now, or there's a chance that it needs to head a little bit lower and come back and test maybe the below 60 in some of these upper 50 areas. At the moment, it's waiting to break out, and if you want to trade it, I think bullish or bearish, you just want to see a resolution out of this range. And once you get that, it's a clear move in either direction, depending on what direction it breaks down or out of. And other than that, I don't think there's much more to be said. I wouldn't mind it going a little bit lower. Be better reflection on gas prices, and maybe we get a better buy the dip opportunity. But if it starts to kind of climb here, It makes, I think, for a trickier trade because there's so much overhead resistance now. And it would be a difficult move. But one thing I will point out is also oil and gas names aren't really reflecting what we're seeing here, at least as far as impending bullishness is concerned. So there's a chance maybe it needs to head a little bit lower, but until it breaks out of this range, I think this is basically one of these 50-50 coin flips where we don't really know what it wants to do. Sam, you're saying that you have a lot of the same trend lines on gold. I would hope you do. Considering I taught you a lot of your technical analysis, it's good to see that we have the same ideas and the same trend lines. That's yeah. I would expect nothing less of you. All right. That covers all the commodities. I think again we're kind of in a tricky spot here with a couple of them. So let's move on to the chart requests. Those two that are still here, stuck around, I'd love to see what else you're looking at. Denise, we'll take a look at Apple and Coke, and then we'll move from there. Anyone else? Wes, I'd love to see what you're looking at. Scott, Ray, if you have anything, I'd love to see. And Ron. All right. Apple. All right, so you have longer term position on Apple, and you have with covered calls, I think, is what you mean, and you're looking. So KO, you're looking at it, but you have no position on Coke. So let's take a look at Apple first. All right, so Apple's a lot like the markets right now, in that we've had. So if you look at it, we can draw a lot of the same trend lines that we have on the Nasdaq, right? We've got this. We had the very narrow channel. We climbed up. We lost that. We've pulled back. It was pretty weak last year, right? So if we take a look at the longer term levels, we still have this key level here, which we're above. And we're still kind of floating in kind of no man's land, right? We go to the weekly chart. We take a look at where we are. Now, there is a key level here, which is what it's dealing with right now. Right? We take a look at it on the daily. You can see that's kind of what we're dealing with, right? The major level is here around 177. We have this intermediate level, which is kind of giving it trouble around 190. It's a longer term play. I don't think there's much you could do right now other than hold it. I don't think it's lost key support. I think it's had a very nice transition back to being bullish. Considering the strength we're seeing on the Qs, I think that you have more. You could give this more leash, and I think that there's plenty of leash to give it. Right? It can come all the way down to 176 and still be fine. And honestly, this is not something that you'd ever really worry about. Now, covered call wise, I think that I hope that you got a good opportunity at this 200 area as the market was kind of pulling to new highs to cover it. If not, like I said before, I think the next bounce on the markets is not going to make it to new highs. So if we get a bounce on Apple in the next couple of days, if it gets to this side of these two trend lines, once it starts to hit, I'd say about 205 to 207, you can start looking at covering it, maybe with 210s to 215s. 215 if you want to be super safe. And maybe add more covered calls in that spot. Okay. For now, obviously you don't want to make a covered. You don't want to do covered calls here. I don't think you even want to add. I'm not sure how big of a position you have and whether it's one of these that you're adding as it drops and then covering as it goes up. But I wouldn't add at this spot. I think I'd want to see it a little bit lower before I would think about selling puts if that was part of your strategy. If not, I'd stay away from that. Okay, so smaller position, no ads, which makes sense. So yeah, I would just wait for more covered. I would try to cover it again once it starts to break over 200. Now, we take a look at KO. Now, this was doing pretty good, and this is tougher because if you're looking, and again, people usually that play Coca-Cola, they're playing for the dividend. They're playing. It's a longer term play, and it's difficult to add in this scenario because it's not at value. Right? When you're playing long-term plays, you're looking at value plays. You're looking at you want to buy at support and you want to buy when it's at a discount, right? This is not at a discount right now. It's actually pretty strong. If you look at the weekly chart, and we kind of scale back a bit, and of course, this is going to be a name that's going to behave well. And you can see we've got a very steady trend. Now, the trend lines may not add up. They may not connect exactly where you want, but they give you an idea of what's happening here, right? It's basically just trending straight up. And if you look at where it's at right now, it's just at a nice sort of range where it's starting to find some pressure, but it's nowhere near value, right? You want to buy, if you want value on this, you want to get it somewhere around here in the mid 40s whenever it pulls back. It may not pull back all the way down here to 45 or 44, but depending on the nature of the pullback, you'd want to look at this area. You can see again, and I'll get rid of the trend lines. I'll give you a little rectangle. Right, you can see this is a good spot. It used to be resistance, and now it's turned into support. So that's the spot you want to look at, and say something like this, like right around $45, and that would be your target as far as where you want to go ahead and enter on a trade like this. Now, that's still you might have to wait months for this, right? But again, it's a long-term play. If you're swing trading this, then it's a whole different idea, right? If you're swing trading this, then you're looking. I'll just close out all this because these trend lines are really just giving you a broad picture. I don't want them confusing me later on. If you're swing trading this, well, I think even swing trading, you don't really have an entry right now, but you're playing momentum instead, or you're playing some of these retracements. That would be a little bit different. But even a swing trader, I think at the moment you don't have much here because again, we're coming up into some intermediate to short-term resistance, and we're up 4 out of the last 5 days. We've covered a lot of ground on a name that's not that volatile, so not really at a spot where I'd want to go ahead and enter this right now. It looks good, especially when you consider where the market is right now. We've been kind of pulling back, and this guy's kind of moving forward, but that's what we're seeing. So 45 puts, that's the right idea. 45 puts probably when this thing is around 46 or 45. Now, your initial entry, I would say 45 puts. Now, keep in mind, sometimes if you sell puts as your initial entry, sometimes all you get is premium and you don't actually get the shares. But that would be the best idea, is somewhere around the 45 area. All right. So hope that helps. Ray, you said KL worked. So okay, so you entered. So you kind of jumped in at the 3280, which is fine. I think you were probably a little premature with it. But you tend to do that. I've noticed quite a bit. But it worked out. I think, again, the reversal pattern to me was kind of tricky. I don't, well, it worked out. But I don't think that, at this point I didn't buy it because to me that wasn't a reversal pattern yet. But glad to see it worked out. Your entry was 3280 and your stop was 3177, which everything was legit. Like as far as your entry price and your stop were fine. I don't know that the candle pattern really gave us confirmation, but if you missed it, then if you didn't enter there, you would have missed the entire trade. It already kind of gave back quite a bit of that move, so I'm not sure if you took profits yet or not on some of it, but we'll see how it behaves from here. But overall, it's doing pretty good when you compare it to what other gold names are doing. Sam, you brought up CMG. Now, Sam, just so you know, you weren't here at the beginning, but I have not heard from Frank. I have no idea what's happening with him or with his situation. Hope everything's fine, but I've gotten nothing from him or from the family, so I have no idea. But I hope he's doing fine or getting better. All right. Now, this is actually a pretty good chart, by the way, Sam. I like what I'm seeing out of CMG. You sold CMG just before the sell-off on IWM. You made 114% on this play. Very good. Very good job. I think this is setting up for a nice play, a nice bullish play. Now, of course, it depends on what the markets do, right? If the markets continue to kind of chop around, this thing might not be able to have the momentum or the support to break it. But this is a nice pattern that we have here. In the short term, even it's even sort of ahead of the markets. right? So if you take a look at how we've kind of sold off the last few days, you'll notice CMG has broken past the descending trend line and has broken past Thursday and Friday's closing prices, right? We're discussing that with the NASDAQ and with the S&P 500, right? So if you take a look at Friday's close and even Thursday's close, we're kind of above those areas, right? So CMG has had sort of a bullish reversal and is trying to make its way back to highs. So we can see it's been, and obviously the chart shows it's been relatively speaking strong compared to what we're seeing in the overall markets. Glad to see that trade worked out for you as well. I actually have it on my watch list. It's a trade that I think still could play out once it does break out to the upside. And so this is actually one that actually looks decent. Now, it's not there yet. This is just a watch list play, right? There's still the possibility of 4 or 5 days to 2 weeks before this thing does or does not break out of these two, one of these two trend lines. But it's one that I haven't watched. It's a one that has shown that I've seen to show pretty good relative strength compared to what we're seeing in the overall markets. All right, let's take a look and scroll back. Did I miss anything? Nope. All right, so that looks about it. Got a couple minutes, but if anyone else has a chart request, cool. I go ahead and add it. If not, we can go ahead and wrap it up for today. I think, again, like I said, the key right now is to try to find plays that are moving sort of a little bit ahead of the market and have some bullish potential. I think that there's a chance that we bounce over the next few days. I think that's the greatest possibility, is that we bounce over the next 2 or 3 days. There is a chance that we stall out. Watch how we close the next couple of days, and that'll give you a better idea of what happens. But I think more likely than not, we're going to get sort of a lukewarm bounce where we sort of move higher, but not back to all-time highs. And then we'll see what goes on from there. Have a good rest of this week, guys. And again, if you have any questions, you can always ask me on Discord, or you can email me at stockdarts@gmail.com and go from there. But if not, we'll see each other again next Wednesday.